Good afternoon. I'm Athanasios Orphanides, a member of the Shadow Open Market Committee, and I welcome you all to the first SOMC webinar of the year. As you know, our events are usually hosted by the Manhattan Institute in New York City, and hopefully before year's end, we will be able to be back to New York for our regular events. But for the time being, I'm thankful that the Manhattan Institute is hosting our events online. Now, our topic today is labor markets and the Fed's monetary policy. As is well known, one interpretation of the Fed's statutory mandate puts equal weights on the objective of, quote, maximum employment and stable prices. The words maximum employment are a significant element in the law. This is an aspect of US central banking legislation not typically associated with the law in other countries. Words matter. Yesterday's events in Washington, D.C. serve as a reminder that sometimes words can have an outsized influence on action with adverse consequences. For economic policy, the Fed's precise interpretation of maximum employment has significant implications for policy success or lack of success. And the Fed's interpretation has evolved over time. Back in the 1960s, the Fed put excessive emphasis on flawed measures of maximum employment, and this led to a period of not the best outcomes for our nation's central banks. Since then, the evolution of interpretations has changed under chairs Volcker and Greenspan. It was considered taboo for many years to even mention the word employment and talk about labor markets in FOMC settings. Things have changed quite a bit since then, and since 2012, we saw that the FOMC has reintroduced the word maximum employment and has been stressing the role of employment in the formulation of monetary policy. So this is going to be part of our topic today. Our program includes two panels. First panel, chaired by Peter Ireland, will focus on labor market conditions and the Fed's employment mandate. It's going to be a panel with fellow SOMC panelists Andy Levin and Mickey Levy. The second panel will be a discussion led by Debbie Lucas and Charlie Plosser with our guest of honor for the day. Our guest today is Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco, and I would like to thank her for appearing to our event today. But I'm going to let Debbie introduce President Daly later on. So let me turn it over to Peter, who will chair our first panel.
Thanks so much, Athanasios. Happy New Year, everybody, and welcome again to the first SOMC event of 2021. As Athanasios mentioned, our first panel will consist of two SOMC members as speakers. Andrew Levin is a professor of economics at Dartmouth College. Mickey Levy is chief economist for the Americas and Asia at Berenberg Capital Markets. Our focus will be on the labor market, so let me just take a moment to set the stage. If you go back to this time last year, January 2020, the unemployment rate stood at or near a multi-decade low, just 3.6%. Unemployment spiked sharply higher in the early spring because of the shutdowns. The measured rate of unemployment reached its peak of 14.7% in April 2020. Since then, as the economy has started to recover, the labor markets have recovered as well. November 2020 is the last month for which data are available. By November, the unemployment rate was back down to 6.7%. So based on that little overview, I think it's fair to say the recovery has begun more quickly and more strongly, I think, than most analysts had expected or even hoped. That's great news. But there's still a long way back before we can say things are all the way back to normal. And that brings us to our questions for today. What do we expect for 2021? How do we even interpret the labor market statistics that we'll begin to see starting tomorrow and continuing for the rest of the year? And most important of all, how do these labor market dynamics figure in to the FOMC's new average inflation targeting strategy. To find out answers to those questions and more, let's turn to our panelists. Andy will speak first, Mickey will follow. We'll be taking questions at the end, so please feed me your questions electronically and I'll get to as many as I can before we wrap up. But enough of the introductions. Andy, over to you.
Well, hello, everyone, and thank you, Peter. I also want to just start by saying a really huge thanks to President Daly. It's really wonderful to have her with us today at this meeting. The Federal Reserve is a critical institution. It serves the American public. It's a complex institution, but the design of it, is intended specifically to have diverse views within the Board of Governors in DC and across the country with the regional feds. And Mary has an amazing, remarkable background. I'm sure Debbie will talk about that in a bit. But again, it's really great to have her with us to discuss these really crucial issues. So with that, let me dive into my presentation. I'm going to share some slides with you. Just give me a second here. So I just want to start by emphasizing that these are my own views, not the views of necessarily anyone else on our shadow market committee or any other person or institution. The Federal Reserve every year has been, since 2012, has been issuing a statement of its longer run goals and policy strategy. It's a really crucial statement. It's like a mission statement. Explain what the Federal Reserve is trying to do in terms of monetary policy and the strategy that's used to carry that out. That statement was revised in August. The revision's an important one, and I'm sure in many shadow meetings to come this year and going forward, we'll be talking more about it. But that statement starts by saying that the Fed is firmly committed to fulfilling its mandate from the Congress. As Athanasios said, it's a dual mandate, often interpreted as a dual mandate that focuses on employment and stable prices. This statement also emphasizes that the Fed seeks to explain its decisions as clearly as possible. And such clarity is not only important for the effectiveness of monetary policy, but also for transparency and accountability that are essential in a democratic society. Another way to say this is that the Fed is not a separate branch of government like the Supreme Court. The Fed is an agency of the government. It has operational independence, but the Fed was created by Congress and it's accountable to the Congress, not to the president. The leaders of the Fed report to the members of Congress on a regular basis. The Congress has given the Fed a very broad statutory mandate, very broad. It could have given a much more specific one, but it's very broad. So like other regulatory agencies that Congress has created, the Fed's responsible for operationalizing that mandate in concrete terms. So what does this mean in practice so that decision makers and businesses in the financial markets and ordinary families and workers understand what the Federal Reserve is trying to do, how it's interpreting the legal mandate that the Congress has established. And it needs to do that as clearly as possible. So the Fed, I think, has done this since 2012. It's clearly operationalized its price stability mandate. It picked a price index, a price index for personal consumption expenditures. And by the way, this move was something that Charlie Plosser, who was then president of the Philly, felt was really crucial in initiating the Fed's clarity about its definition of price stability, consistent with its mandate. And in August, the Fed's clarified further that it's seeking to achieve an average inflation rate of 2% over time. Again, there's interesting issues to discuss there, but we'll leave those for a different time. The question I want to raise in these few minutes is there's a lot of room for the Fed to make further progress in operationalizing its full employment mandate. It needs to quantify what does that mean in practice. The statement emphasizes that it can't specify a permanent fixed goal, because the sustainable maximum level of employment varies over time. It depends on structural factors. It depends on other government policies. But given the mandate Congress has given, the Fed does have to make policy decisions that are informed by its assessments of maximum employment. And the Fed acknowledges that in its statement. In fact, the Fed says it considers a wide range of indicators in making these assessments. But remember, the Fed said it's going to try to clearly explain. It's important for transparency and accountability. The Fed has to start publishing its assessments of maximum employment. That's the basic point I just want to make now. The Fed really needs to start publishing its assessments, its quantitative assessments, along with measures of uncertainty. It needs to explain the methodology that it's using to make those assessments. These assessments are a key point in the policy decisions, so they should be published along with the other quarterly economic projections, the summary of economic projections that the Fed produces 4 times a year. The methods, when they're updated, explanation can be given. And in the Fed's reports to Congress, those reports should henceforth include these assessments of maximum employment. That could involve a new congressional act to require the Fed to do this, as well as to quantify its price stability mandate. But the Fed can move forward more quickly than that. It doesn't have to wait for legislation from the Congress. The Fed should be open and transparent as possible in explaining how it's operationalizing its mandate. Now, if you thought, well, it's impossible to do, we wish we could, but there's no practical way to do that, I don't think that's correct. So I'd like to spend the rest of my few minutes here just to talk briefly about ways of measuring full employment. And some of these are better than others. One is U3, that's the conventional measure, people who don't have a job, but they're actively searching for work in the past 4 weeks. Another one is U6, people who've actively searched in the past year, but not in the past month. U6 also includes part-time workers who are seeking a full-time job. Another measure people have been looking at, especially this year, is the ratio of employment to the population of people over age 16. People call that EPOP. And then I just want to flag a measure that I've proposed repeatedly over the last decade at Hoover and in other published research papers with Professor Blanchflower and other colleagues, that combines together the unemployment, the people who've dropped out of the workforce but who could come back, and the underemployment of people who are working part-time but would like a full-time job. And all those pieces are important. Those should all be coming into the Fed's assessments of full employment. So just briefly, U3 has some really noticeable shortcomings. One of them is distinguishing active versus passive search. And I don't have time to go through these details here. We'll post these slides on the Manhattan Institute website if you want to look at them carefully. There's a lot of transitions in status between U3 and not in the labor force from month to month. And then there are people who drop out, as I mentioned before, who give up searching because they just couldn't find a job. They leave the labor force. They're no longer measured in U3. And this could be very misleading. For example, in 2010, 11, 12, the unemployment rate was coming down pretty rapidly at the same time that people were leaving the labor force. They were discouraged. And so U3 can be very misleading in some of those circumstances. U6 is an alternative. It's better than U3 in some ways, but still not perfect. It excludes people who haven't searched in the past year. And so in a protracted recovery like we had 10 years ago over the past decade, U6 still misses a lot of those people who've dropped out. It's better in terms of underemployment, but it's a little bit like adding apples and oranges in how it handles that. The problem with EPOP is that it's good at measuring the people who've dropped out, but it completely ignores the underemployment of the part-time workers. And you can see here, both in the past recession and the current one we've been experiencing, that the underemployment rate had huge deviations from normal. And over this past year, it skyrocketed. It's come back part way, but still quite far from normal. So what I proposed in my various papers over the last decade is to construct an employment gap that includes all three of these pieces: the unemployment rate, the participation gap, and the underemployment. And what you can see here, just looking at this past year of 2020, using the latest employment report, there'll be a new one tomorrow, we can update this. But as of today, the blue line is showing you what the unemployment gap, that's the deviation of unemployment from where it was at the beginning of 2020. As Peter Ireland mentioned, it went up a lot. it's come back down quite a bit, but still, several percentage points above its previous level at the beginning of 2020. But the employment gap is about twice as big. So it's a similar pattern, but the magnitude is much larger. And that's because there have been people who left the labor force in 2020 who would hopefully come back. And there's people now working part-time who want a full-time job. And those should be incorporated into the Fed's assessments of maximum employment. Finally, I just want to mention there's really important disparities across demographic groups. I'm personally a big fan of the household pulse survey that the Census Bureau has been producing. That survey indicates that 30%, about a third of US households, are still experiencing losses in employment income, and that's most severe for families, for Black families, Hispanic families, and for people who don't have a college degree. And those disparities are also relevant for the Fed's assessments of shortfalls from full employment. So just to conclude again, the Fed has a broad statutory mandate. It needs to operationalize it in a transparent and accountable way. So I'm going to stop there and turn to Mickey to fill in everything I've missed.
Okay, thank you very much for this opportunity. As Athanasios said, this is exceedingly important. I think the paper I've written for this has either been posted already on the Shadow website or will be, but I do have some slides. If they're going to come up, they will. But so if we think about the Fed's new strategic framework, it's really elevated its long-run employment mandate as a priority, expanding it to maximum inclusive employment, and it's introduced an asymmetric, flexible form of average inflation targeting that features a makeup strategy and for the purpose of overshooting its 2% target right now. So if we think about it, these are very lofty and laudable goals, and they're the type that politicians promote, and of course the Congress really appreciates the Fed's new strategic objectives, but the Fed's interpretation of its objectives are decidedly fuzzy. We know the Fed hasn't given us any numeric parameters on its overshooting of inflation, and it really as Andy notes, it's equally fuzzy on maximum inclusive employment. And the Fed also, in its long-run strategic framework, really doesn't establish a strategy for how it's going to achieve these objectives. So in my presentation, I'll provide a quick assessment of labor market conditions and then make some observations. But my observations are largely in the form of questions that are critically important to the conduct of monetary policy that really haven't been answered. And so I'll go through these and then encourage the Fed to address these questions and undertake the research necessary to provide clarity to them as a way of leading to a really monetary policy strategy for achieving its objectives. So beginning with the labor market conditions, as Peter pointed out, before the pandemic, when you look at either the unemployment rate or the unemployment rate for different groups, the unemployment rates had reached all-time lows. Now, one shortfall was the labor force. You could show the next page, please. The labor force participation rates had come down since the late 1990s. They had come up in the decade since the financial crisis, but they're still below where they had been earlier. And so the employment to population ratio has come down. Now, the government pandemic, of course, and the government shutdowns generated a huge contraction and then a strong but partial rebound. And I would note, looking at the right-hand side, I just looked at some of the categories that the BLS publishes that the goods sector has been very, very strong and rebounded, but the services are the ones that are really lagging, and the employment shortfalls there are literally in the millions. And we can expect that, when the economy bounces back to where it was, which includes the services industries, these are the job gains that are really going to jump up. Now, next slide, please. If we look at the details of the unemployment rate, they jumped up dramatically with the pandemic and government shutdown. They've come down dramatically by even for those with lesser education on the left-hand side and on the right-hand side for every group, but the unemployment rates are decidedly higher than they had been. So there's clearly a shortfall. And now please go to the next slide. So clearly the economy is going to recover, but labor markets are probably going to lag. And what we've seen recently is some indicators of what labor economists call scarring, that, temporary layoffs are coming down. There looks like more of the job losses are permanent. So now so clearly there are shortfalls, even though there's been a lot of progress. But even with these shortfalls, now's the time when the Fed needs to establish, parameters for clarifying its long-run objectives. And even if they're not quantifiable, it needs to discuss them in a richer way than simply to say they're not directly measurable and we're looking at a wide range we're considering a wide range of indicators. Now, the Fed has acknowledged that the Phillips curve is flat and that the NAIRU, the non-accelerating inflation rate of unemployment, is not a reliable framework for conducting policy. But what is appropriate? What has replaced these two frameworks that the Fed relied on for so long and no longer can? So let's consider the fuzziness of maximum inclusive employment. Were the unemployment rate lows of the end of 2019 benchmarks for full employment? Andy just showed January 2020 as one benchmark. If those weren't benchmarks, what are they shortfalls from, and how should they be assessed? That is, how do the new maximums relate to, or are they a function of real or nominal interest rates? Wages, or inflation, despite the shortcomings of the Phillips curve. So I understand why the Fed, in its strategic statement, says it cannot quantify these maximum employment objectives. But I think it would be very valuable to provide the public and itself some rigorous assessment of how it arrives at what's a shortfall and what is maximum. Now, keep in mind that the Fed has also acknowledged that the employment and labor market performance is determined by non-monetary factors, including demographics, education, and skills, health, regulatory policies. And if you look at the wide array of research conducted at the board and at the different Federal Reserve banks, a lot of the researchers are doing some very good research on this. And so I think it's time that the Fed needs to sort out the effects of all these various factors, and do so with the objective of trying to determine a set of appropriate policy tools that are best used for achieving its desired outcomes. And this will clarify the Fed's capabilities. So consider that the pandemic and government shutdowns were negative supply and demand shocks on the economy. And since then, during the pandemic, there have been technological advances and new products and new economic activities that are likely to change the supply and demand for certain types of labor market skills and groups. So we need to address the shortfalls, but this requires changes in policies in education and skills training and regulations and fiscal support. We need to understand the role of monetary policy as an aggregate demand tool in addressing these shortfalls that are a combination of supply and demand shocks, and as Andy points out, the labor markets are fluctuating, and maximum changes over time. Moreover, by the very nature of labor markets, participants have very, very diverse skills and productivity, and using monetary policy exclusively to achieve maximum inclusive employment would lead to excess demand for high-skilled, high-productivity workers, and presumably overheating and unintended side effects. So what I'm asking, I absolutely applaud the Fed for setting out for a very laudable goal of maximum inclusive employment, but I'm trying to do some soul searching and say, how do we best achieve this? And I'm of the view that careful research is going to show that it cannot all be done through the Fed's aggregate demand policy. So more broadly, I think acknowledging the flaws of the Phillips curve was wise, but the Fed needs to, in a very broad sense, dig in and analyze how its monetary policy affects employment and labor markets. And you could say this, your first thought might be, that's a very naive observation. But maybe it isn't. Let's consider the changes since the financial crisis. There have been changes in the Fed's operating procedures. There have been unprecedented interest rate and balance sheet policies, but there are clear bottlenecks in the monetary and credit transmission channels. There are changing relationships in the real economy. Okun's law has fallen apart. And there are changes between relationships between employment and wages alike. The Fed needs to more broadly assess the linkages between its monetary policy and its dual mandate objectives. So consider the following questions that I think now go unanswered. Why didn't the Fed zero interest rates in QE 2 and 3 generate stronger growth or higher inflation? Would the gains in employment since then, which there have been very solid gains up until the pandemic, would they have occurred without QE2 and QE3? Why did the Fed's macro model persistently overestimate growth? So I understand these are very tough questions, but I think research into them would help develop a systematic way for the Fed to achieve its new mandate. And the alternative that we seem to be aiming toward is the Fed trying to achieve its objectives by using the same monetary tools that in the past didn't achieve the objectives they were hoped to. And so to summarize, I just think that it may be better to come up with a more reliable strategy by digging in and doing the research and answering some of these tough, outstanding questions that we're all scratching our heads about. And Peter, I'll stop there.
Thanks very much, Mickey. Again, we're happy to take questions, so please feel free to feed them to me electronically. Athanasios, I think you may have a question. Can we put Athanasios back on?
Hi all. I'm just catching on the question here. So
maybe you can read the question, Athanasios, so everyone else knows.
Oh, I'm sorry. I thought this was you asking the question.
Okay, so let me see. So the question is if Nelson and Charlie Plosser are right that output is integrate of order 1, the output gap may just be a statistical illusion, but the unemployment gap is more likely to be meaningful. So if we take this into account, how do we discuss, how do we examine the output gap or the unemployment gap? So it's I guess let me just briefly mention the issue goes back very much to what both Andy and Mickey have been asking, which is how do we identify what this ideal measure of maximum employment, that I would actually prefer maximum sustainable employment that is consistent with price stability. And this is not something that can be answered with just simple univariate or even multivariate statistical constructs. So this is why we have the complication right now, where as Andy and Mickey mentioned, the FOMC has told us that they're looking at a number of things, which is true, they have to, but we need a little bit more information than that to figure out exactly how to interpret the answers that are provided. And as Andy pointed out, we need some more information about how to read the information that is provided and how it corresponds to this concept of maximum employment. So the SEP, for example, provides every FOMC participant's estimate on what each FOMC participant thinks is the normal rate of unemployment in the long run. But we have not seen a translation of that to the concept of maximum employment. And we have not really been seen whether that is the notion we should be looking at to understand what shortfalls from maximum employment are. And this is where the discussion that both Andy and Mickey have put forth raises some fascinating questions. I hope we're going to have some discussion on in the second panel.
Thanks so much, Athanasios. I have two questions from the audience. I think the first I'll direct first to Andy, and then the second to Mickey. Andy, let me begin just by paraphrasing the question and maybe re-asking it in a slightly different way to sharpen it and to make it dovetail more nicely with your excellent presentation. The audience member asks about the minimum wage jobs and points out that someone working full time at minimum wage, certainly wouldn't be earning enough to support a family. Certainly wouldn't be enough, to support themselves in a household by themselves. You talked about a range of measures of full employment, measures of labor market slack or labor market performance. But this question touches upon a slightly different concern, I think, and you might say that this is job quality. If as the recovery proceeds unevenly, many workers find themselves taking jobs that offer lower wages than they earned before the pandemic, or that are not high quality jobs. So let's just say there's another dimension along which the labor market is not performing up to par, and yet obviously the individual would be counted as employed and full-time employed. Have you or your co-authors or anyone else thought about ways of capturing those dynamics in measures of employment?
Yeah, actually, it's a great question, and I really appreciate it. This is Janet Youngblood who asked it. The work I've done with Professor Blanchflower actually, is very much focused on this issue. It's an MBR working paper we put out a few years ago. But a simple way to describe this is to say that when the job market's lousy, it's really hard for even someone who has a job to get a raise. And oftentimes it's tough for the employer to give them a raise, frankly, because part of the reason the job market's lousy is because people don't have enough money to spend, and that employer may not have a lot of revenue that they can, increase the wages of their employees. So as Mickey said, some of this needs to be addressed by other kinds of policies, fiscal policies, regulatory policies, education policies, and so forth. Okay, but I think that part of it is a monetary policy issue, particularly when inflation's running too low, as it has most of the past decade. Part of what the Federal Reserve was trying to do was to create a stronger labor market in which employers would be willing and able to give pay raises to their employees, including the ones on minimum wage, and to hire more. And if there's fewer people on the margins of the workforce, the employer can't just say, well, sorry, I'm not giving you a raise. If you don't like this job, then quit. I can hire someone else. In a hot labor market, which is like the one we saw in the late 90s, there were people who had an arrest record or even a conviction on their record who in a loose labor market couldn't get a job at all. And in a tight labor market in the late 90s, those people were able to find a job and start to accumulate experience and get pay raises and go above the minimum wage. Likewise, with someone who's disabled, when the labor market's lousy, it's the employer's reluctant to make accommodations for that person. And so it's tough for a disabled person to get a job. ADA, American Disability Act, says that there should be no discrimination against disabled people, but in practice, that's very difficult to enforce when the job market's lousy. When the job market's hot, like it was in the 90s, and like it was up until the pandemic, we started to see more and more people coming back into the workforce, including people who hadn't been working for quite a while. And that's a good thing. It's a good thing for our society. It's a good thing for people's well-being to have a network of colleagues they're working with to do work that they feel like is important, that they're being paid for. They don't have to depend on social public assistance. So again, the Fed can't solve this single-handedly. That was Mickey's point. But the Fed does have a key role to play.
Thanks very much, Andy. Let me ask this question of you, Mickey. This too is from the audience. The question briefly is, will overshooting the inflation rate help lower unemployment at this time? Let me link this up to something you said. You mentioned that in some ways, this is a curious thing. The Fed's new strategy downplays the Phillips curve. In another way, however, it leans even more heavily on the Phillips curve because it seems to reflect the notion that if we allow inflation to run above 2% for a while, that will help us buy lower rates of unemployment, at least temporarily.
Peter, so to answer the question, will overshooting the inflation rate help lower the unemployment rate? The answer is no, not permanently. And that's the point Athanasios made when he used the word sustainable maximum employment. And I think that's critically important. I'd like to take that a step further and make a comment on what Andy said. Yes, there are people who are highly productive workers and lower productive workers, and higher skills and lower skills. And we want the labor markets to be efficient, but the labor markets reflect a wide array of supply and demand for different types of skills in the labor market. And one thing I'll just emphasize, what we need to do is set out objectives, maybe that aren't quantifiable, but that can be that can be referenced to things. We need, if we don't like U3, the unemployment rate, if the Fed is looking at the employment to population ratios, then say so. And set out some parameters, and then ask the question, what government policies are best able to achieve these? Because if the Fed sets them out as a goal is fine, but to try to achieve them all through monetary policy, it doesn't work. And so we need to, and you can't just, as you know, I understand why Chair Powell has said, we need more fiscal reliance on fiscal stimulus. But is he thinking of fiscal stimulus from an aggregate demand point of view, or some of the how do you address some of the shortfalls? And so once again, I think just we need to do, if we're going to really take this seriously, and if the Fed is, we really need to do some soul searching. And once again, soul searching, not just about labor markets, but how monetary policy links to those objectives, and where are the shortfalls? And it's beyond our time framework here, but we've talked at other times about the monetary policy transmission mechanisms and a whole array of issues. And I'd like all of these to be discussed and on the table for really formulating a strategy, rather than just saying, let's set out this broader goal and, oh yeah, we're going to use the same policy framework we always have in the past.
Agreed. I think Mike Bordeaux has a question.
Yeah, so I have a question which I guess relates to what both of you have said, maybe closer to what Mickey was talking about, and that's to ask about inflation. So you're focusing on unemployment, but yet if the Fed follows these policies, it probably is going to lead to an increase in inflation, as was just said. I know a little bit about inflation. I'm an economic historian, and like what I worry about is if inflation starts to rise above the Fed's 2% target and then rises quite a bit, then how is the Fed going to control this? I mean, if inflationary expectations start to shoot up, we could get ourselves into a situation like we saw 40 years ago. And in a sense, I guess I'm getting back to something which is like behind all this discussion about employment, which is, it seems to me like the Fed's main mandate should be to maintain stable prices and low inflation. And I've never quite bought the dual mandate. So in a sense, when you're talking about unemployment in isolation, you can't. You're always going to have inflation appearing. And this seems to be a big problem coming up in the future.
That's a lot, but could I make a few comments based on that? Okay. The inflation's generated when you get excess demand for all goods and services relative to productive capacity. And with this shortfall now in nominal GDP, no question there's insufficient demand, so there's no price pressures. But I do expect that when the pandemic ends and you have this unprecedented amount of monetary and fiscal stimulus in the pipeline, you will get to the point where you have excess demand. And that's going to put upward pressure on prices. Particularly, let me point out that of the PCE price index, 70% of it is services. And once the pandemic ends, those services, the demand for them is really going to bounce back. So then you're put into a situation where if you start getting higher inflation, then you can run into some problems because while the Fed says they'll know what to do, the markets, I think, will move in anticipation of that, and it could be jarring. And that gets back to Athanasios' point. The best way to, our goal should be sustainable maximum employment. And actually, if you look at history, the Fed does best, and the unemployment rates do best, and the employment to population ratios come down the most during long expansions. And how can the Fed best contribute to long expansions? And that's not to overheat. But, Mike, let me just say, we've been through 10 years when inflation stayed low. The situation now in terms of monetary and fiscal policy is far, far different than what it was following the financial crisis. And I'd say people may be surprised that inflation does come back, and that will be inconsistent with sustained maximum employment.
Let me follow up briefly on that last point, Mickey, just by paraphrasing or adapting a question from the audience. You've spoken about fiscal policy, monetary policy, their roles in supporting the economy with growth without inflation going forward. We're in a strange time, however, in the sense that there are a myriad of unprecedented fiscal and labor market policy actions in place right now. Some of them are helping families by cushioning their income in the face of job losses, but also potentially putting upward pressure on the unemployment rate itself. A, do you see these policies, paycheck protection or the enhanced unemployment benefits, do you see the effect of these programs on the unemployment rate either now or in the future being material? And if so, doesn't that make the Fed's task even trickier, gauging appropriate monetary policy, again, not knowing really, where the natural rate is?
So Peter, if I could jump in here for, because we're almost out of time. And first, the Congress is the Federal Reserve's boss, and there's times when someone says, well, I don't like what my boss is asking me to do, but Congress has asked consistently for the Fed over the last 40 years, more than 40 years, maximum employment and price stability. That's what the boss wants. The Federal Reserve should do it. It needs to define price stability, which it has done. PCE price index, 2% average inflation rate, period, okay? And Congress seems reasonably satisfied with that. The Fed needs to explain what its assessments of maximum employment are and explain those to Congress. And when there are trade-offs, which there may be, this is the point that Mike Bordo was making and that Mickey is also emphasizing, Athanasios, okay? There can be times when there are trade-offs. I don't think there were any trade-offs over the past decade, but there could be in the future. Then the Fed needs to explain to Congress, here's how much we think is the shortfall of employment. Here's what's happening to inflation. Here's our plan. Here's our strategy. And hopefully Congress, okay, that seems fine. That seems reasonable. Go ahead and do it, okay? Or Congress might have some feedback. The Fed needs to have operational independence, but it also has a boss. It's not an independent branch of government. Now, the final thing I want to say is that Mickey and Mike Bordo and I have written a paper about the role of scenario analysis to help clarify to the public and the Congress the risks that the Fed sees and how it might respond to those. What are its contingency plans? And I think part of the answer to Mike's question here really is in the paper that Mike and Mickey and I have written. It's an NBR working paper and a Hoover working paper. We'll hopefully be able to revisit it again in maybe one of these upcoming shadow meetings. So I'll stop there.
Hey, Peter, before you end, look, I think it's very important to just make the following statement in response to what your question was. The nation's incurred a very large negative shock. It is absolutely the proper role of the government to provide income support and support to small businesses. I think it's critically important going forward that the fiscal authorities be judicious in providing support to those who are unemployed and who really need it versus just writing checks to the vast majority of the population. And I think it's very, very important for, once again, the Fed to encourage not just the fiscal policymakers to stimulate more, but to, with a lot of the research the Fed has done around the system, to express where it's capable of helping out labor markets and where other non-fiscal, non-monetary policies may be the most useful tools for helping labor market outcomes that we all want.
Thanks so much, Mickey. Thanks, Andy, and thanks, Mickey. Obviously, we could go on and discuss these things all night. That's probably what we would do if we had free rein, but our distinguished guest is here, and I think it's time to move on. Thanks, too, for all of the audience members who contributed questions. Excellent questions. Thank you so much. So as I mentioned, our distinguished guest today is President Mary Daly of the Federal Reserve Bank of San Francisco. We're very excited to hear from her next. Interviewing President Daly will be two Shadow Open Market Committee members, Charlie Plosser, former president of the Federal Reserve Bank of Philadelphia, presently a visiting fellow at the Hoover Institution, and Deborah Lucas, Sloan Distinguished Professor of Finance at the Massachusetts Institute of Technology. Debbie, I'd like to turn the podium over to you now.
Great, thank you, Peter. Well, it's my pleasure to introduce Mary C. Daly, who's served as the 13th President and Chief Executive Officer of the Federal Reserve Bank of San Francisco since October of 2018. She's had a long and productive career there. She joined the bank as a research economist back in 1996, and most recently was Executive Vice President and Director of Research before assuming her current role. President Daly's research background and expertise is particularly relevant for the challenges of the current moment. Her research has focused on labor force dynamics and on the impacts of monetary and fiscal policy. She's published influential work on wage, employment, and labor force dynamics, economic inequality, the economics of Social Security and disability, and on evidence-based public policy. Also notably, President Daly has worked to increase diversity and inclusion within the Federal Reserve System and within the economics profession more broadly. So I know I speak on behalf of all my fellow SOMC members to say just how delighted we were when you agreed to join us for this interview. And then on a personal note, I have very fond memories of working closely with you many years ago when we were both members of a Social Security Technical Advisory Panel. Your good sense, good humor, and good heart were all already very apparent at that time, and I'm so happy to get this chance to reconnect with you in this forum. So I'm going to ask you a few questions related to your views on current impediments to the transmission mechanism of monetary policy, particularly as it pertains to the labor market and to its implications for the Fed's monetary and regulatory policies. Then I'll turn it over to Charlie Plosser for his questions. And after that, we'll open it up for questions from other SOMC members and from the audience out there, and you can submit your questions online as you've been doing. So just to get started, clearly there's a lot of headwinds right now for monetary policy. We're in an era of near zero interest rates. Capital already seems cheap, at least to large firms, and pandemic-related factors are depressing demand. On top of that, the Fed is forced to operate further out on the yield curve, where its actions may be less relevant in terms of helping small businesses who are important, very important to the job creation process. So with all of that in these circumstances, do you see the effect of Federal Reserve rate cuts on unemployment as being weaker than in normal times? And I guess more generally, could you kind of describe what you see as the operative channels of monetary policy on employment, particularly at this moment?
Sure. Well, thank you all for having me. Hi, Debbie. Hi, everyone. And I'm delighted to be here. So that's a lot of things. So let me just sort of begin by starting with the monetary policy transmission mechanism and the significant worry that people had that it was going to be really ineffective as the pandemic hit our shores. I remember having conversations with academics, other policymakers outside of the Fed system, and in my context, who worried that interest rate cuts really couldn't do much in the wake of a pandemic. But let's go back to what we saw. We saw that we lowered the Fed funds rate immediately at the onset of the pandemic. And then after that, what we've seen in the data, what has been really important to the economy, is mortgage rates started to come down, car loan rates came down, small business loan rates came down. Importantly, we saw consumers refinancing mortgages, buying homes. We went out and asked, okay, when you're refinancing mortgages, are you taking equity out of your homes and using it to support spending? No, luckily the fiscal agents had provided some fiscal support for that. What people were doing was simply getting their monthly payments down, better positioning them to have disposable income to facilitate consumer spending. So I see that as exactly what monetary policy is meant to do. It's meant to lower the borrowing costs and then allow people to do the things that put more money in their pockets and also spur additional investment in houses, for instance. People were buying cars, buying houses, refinancing, of course. Small, medium-sized businesses, when they were not in the directly affected sectors, were able to get lower cost borrowing, continue to maintain their employment, buy inventories, et cetera, through this pandemic. And for those who needed more than just a lower loan rate, they needed grants. Well, the fiscal agents, that's the role of the fiscal agents, because, you know, we've said many times, and you all know on this committee, we have lending, not spending powers. And so we're really facilitating that. So I looked at the data of the last, 6 to 9 to 8 months, and I said, this looks like the monetary policy transmission that we've talked about in beginning macro textbooks is alive and well and facilitating support for the economy to the extent we can when we're also constraining ourselves in terms of sheltering in place. That absolutely has a direct effect on employment. We don't have the counterfactual, of course, of what if we hadn't done these things, but my expectation if we hadn't taken these actions and if monetary policy wasn't working was that the unemployment rate would have gone up by even more. Many businesses that were able to find themselves refinancing mortgages, etc., wouldn't have been able to do that, and they would have shuttered and been other victims of the pandemic than the ones we've already tragically seen on the economic front. So I think of our policy as working and it working well. And of course, we did have to a final question, because you talked about the yield curve. We're buying assets up and down the yield curve across a range of maturities, and part of that is to assist with market dislocation that occurred right in the aftermath of the pandemic, but it also provides accommodation. And what I look at when I say is being out on the longer end, it's not a trade-off. It's not if you're at the longer end, you're not at the short end. Short rates are very low. Long rates have remained low. That helps longer-term borrowers be in that market. But the short rate, I think, is significantly lower, and small businesses are able to get that funding. Right now, the constraint on small business lending, when I talk to my contacts, when you look at the data, isn't on the rate. It's on, are they a viable business, and what kind of forgivable loans do they need, like PPP loans, in order to really bridge themselves over the complete coronavirus.
Great. So I was just thinking that, in fact, the refinancing channel was something I've been thinking about a lot, and something that's very different than 2008 is, although unemployment is an impediment to refinancing, property values are actually going up, which took away some of the constraints that was blocking that channel of monetary policy in the last recession. But I guess that's a segue to turning to some things that actually were implemented after 2008 in response to what happened. And in particularly, I want to ask you about some of the regulatory changes that could be impediments to the effectiveness of monetary policy now, particularly as it affects bank lending to smaller and somewhat riskier borrowers, which is obviously a group that's important to job creation, and also where equity considerations are perhaps more important to the Fed than in the past. So just to be clear, there was, a lot of prudential regulation that made it relatively more expensive, perhaps in terms of capital, to lend to riskier borrowers. And I wonder if, with this new emphasis on equity considerations, you think there could be some rethinking of that, or where you stand on all of that.
So great question. And, I really appreciated the presentations we saw, Andy and Vicki, the presentations you gave on this. You did something in the labor market that also is true in the financial markets and in the lending markets, and that you exposed the complexity of the issues we face, right? If we want to have an inclusive economy, we have a myriad of issues we have to consider. So let me start with banks and the aspects of Dodd-Frank and other regulatory parameters that were taken, or legislation that was taken, to really make sure that banks are well capitalized, that banks come into a downturn, whatever the making of the downturn, this has been a COVID-related downturn, but whatever the downturn, come in well capitalized and ready to lend at the times the economy needs lending the most. And so what I feel really good about, if you think about evaluating how well we came into this pandemic, we were on strong economic footing, growth remained solid, and banks were well capitalized and well prepared when the pandemic hit to lend to businesses, help with forbearance and other things that were needed, and also facilitate all of this PPP lending that took place, or Main Street lending. And in fact, some of the, not all of the, lower take up on Main Street was in part because medium-sized businesses were getting those fundings, and for the ones that weren't. They needed other parameters on Main Street than the ones that were originally offered. So these are aspects of a well-capitalized banking system that I think are so important. That helps every American, whether they're a medium-sized business, a small business, or simply a borrower trying to get a car. So these are really important. Now, if you think about equity and equitable lending, these are issues that should be at the top of our priority list. We know that we need low and moderate income families and communities to have access to wealth accumulation. The best vehicle for wealth accumulation, of course, often is a house, but other assets as well, businesses. And so having access to that borrowing is important. But one of the main lessons I learned from the financial crisis is we do no one a service if we lend money to them that then isn't easy to pay back or is on some adjustable rate mortgage system that then penalizes them and they lose everything. So I really would like us to think hard about how do we do smart lending and create an open opportunity for individuals to be participatory without being at the end looking like they were victims of a predatory scheme where that equation didn't work for them, it didn't work for the community, and it didn't work for our economy. I think one of the levers that the Fed is recently thinking hard about is the Community Reinvestment Act, which isn't directly to individuals, but very much relates to low and moderate income communities. That act has served us well, but is really in need of modernization. And so having that open for public comment and thinking about how do we devise schemes, regulatory schemes, and that help with public-private partnerships, but also get the funds that are needed to the communities. These are all the issues that we're going to have to tackle post-pandemic. I would argue, I will state, my view is we needed to tackle those anyway, and the pandemic just put a magnifying glass on how critical those needs are.
Great. So I guess you've already touched on it some, and certainly it was the center of the interesting discussion that preceded this. But I wonder if you might say a little bit more about, given where we are and changes in objectives, whether there's any other policy changes that come to mind that you think would strengthen the pass-through of monetary policy, particularly in this kind of zero lower bound environment, without compromising the Fed's other objectives. And then again, as everyone has been talking about more broadly, what is your view on what's feasible or advisable to try to accomplish via monetary policy and the regulatory tools of the Fed, as opposed to fiscal policy or through regulations elsewhere in the government?
Sure. Well, let me start with the first question, and I'm going to go a little bit outside of what you might expect on this. But one of the things the pandemic has taught me, and it's happening, but the pandemic's been a forcing function. It's really forced us to look at it, is that the financial system that serves so many of the communities that we're interested in reaching with our policy tools isn't in the traditional banking system. They're using what often gets called fintechs, but these other important areas, community depository financial institutions, they're important entities in these communities. And so we really need, in my judgment, to think about the smart acknowledgement that they need to be included in how we think about our policies going forward, whether that's our facilities, but importantly, think about monetary policy. We lower the interest rate. I was struck by in other countries, if the interest rate gets lowered, there's sort of an acknowledgement by the institution that lowers the interest rate that it's a good time to check the mortgage rate, and it's a good time to check your financial health. Are you rightly positioned? We don't do much of that. And if you think about recent research has come out from the Atlanta and I believe the Philadelphia Fed, I think I have that right. There's a paper that's just shown that, on average, white Americans refinance really pretty quickly, but African Americans, Hispanics, much less quickly. So those are obvious gaps where we could improve the transmission of just simple interest rate cuts into the communities that are not probably getting that transmission as easily or as quickly as needed or as is optimal for our economy. Now, you asked me the second question. I think, let me paraphrase and see if I got it right, Debbie, is that it's, what role is the Fed versus fiscal policy and in the economy more generally, and certainly after COVID? And, we've heard of this in the other speakers, Peter, Mickey, and Andy all said it. It's that really the Fed can't do everything, but I liked what Andy said. The Fed can't do everything. There is absolutely no way. We're one aspect of it, and we have pretty blunt tools to go after all of these different things that we need to in our economy. But we're not working alone. We're working in partnership with fiscal agents. And in partnership, I don't mean non-independently. What I mean is, if you're thinking about public servants and you think about why we put these institutions of government together, it's really to try to make sure that society and the economy get what they need, what we need as a nation in order to continue to grow, set the conditions. So we're doing our part. I think that's what we've spelled out in the framework and what we've done in our policy initiatives so far and our policy moves and our statements. But we couldn't do it alone. It wouldn't be possible. And I push back heavily, as you've seen many, many Fed officials out pushing back heavily on this idea that the Fed could get us out of this single-handedly. That's just not possible. It's not even in the design of the system. So we need fiscal agents to participate. We need those policies to be taken, and we need to have all of us basically participating in order to do well. And I would say that's state and local governments as well as the federal agents.
Great. Well, thank you so much. I'm going to hand it over now to Charlie to start asking you the harder questions. Charlie, take it away.
Thank you, Debbie. Mary, just let me add my own thank you for being here today and your presence. And I'm anxious to get some of your insights. My questions mostly have to do with some of the issues that were raised in the previous panel, as you might imagine. The reinterpretation, if you will, and Debbie touched on this, the reinterpretation, if you will, of the mandate to focus more on equity and inclusion, I think is laudable in many ways. I think the question a lot of people have and that were raised during the first section is, all right, monetary policy is an interest rate tool for the most part. You just talked with Debbie about a number of regulatory issues that the Fed could do through CRA, which was kind of overtaken by the Consumer Finance Protection Bureau. And I remember when I was president, the Fed lost a lot of employees from the Fed's CRA and community affairs, not community affairs, but doing CRA type regulatory issues. They went over to work for the CFPB. So I think but that's a regulatory issue from my perspective, as is bank capital and other things to get banks to do things. The statement issued by the Fed in August was about monetary policy, and the mandate from Congress is about monetary policy. So my question for you is, let's sort of go back to not about regulatory issues, but focus on monetary policy. And there, our major tool, the Fed's major, I say ours, so they say that sometimes. The major tool used is interest rate policy. And I guess my question is, and I think you said this just a minute ago, monetary policy's major tool, interest rate, is a rather blunt instrument. And yet the notion that we want to achieve, desirably so, a more equitable, inclusive labor market in that context, it's very hard for me to understand exactly how the Fed will operate and think about this when the primary instrument they have is such a blunt instrument. So there are lots of relative prices there. Do we worry, as Andy said, about labor force participation rates, or is it unemployment relative to demographics, geographics? Some regions of the country have chronically higher unemployment rates than others. Whether it has to do with gender disparities. I mean, we can create all sorts of relative metrics about employment. And what I'm struggling with, or I think many people will ask you, well, how is monetary policy going to change what most economists would describe as relative prices? These different more equitable, more variable, more equitable or closed differentials that may exist? And how do you think about that in the context of your work on labor market and on monetary policy?
Sure. Okay. So let me tackle that. So let me start by going back to something you said right at the outset, which is that this is a reinterpretation of our mandate, and I will push back on that. I think of it as a clarification of how we're going to strategically approach our mandate. But as part of the framework review that the Fed undertook as part of our work with Federalists, et cetera, I went back and reread the Humphrey Hawkins legislation. And in that original work that gave us what would now comes to be termed the dual mandate, it really is about being in a broad and inclusive labor market. It's a broad and inclusive goal. So I think of it as an evolution as opposed to a revolution. I think I'm borrowing from Vice Chair Clarida's words when he announced the framework, but I really like that. It is an evolution. It's not a revolution, and it's a clarification more than a reinterpretation, at least in my judgment. Now, when you think about, well, Mary, how are you going to do this? Let me just go back to, I don't even have to go back to the 1990s, although I think that's an incredibly good example. But I remember coming to work in 1996. In the 1990s, many economists, labor economists, macroeconomists thought, well, that's the roaring 90s. That's hard to repeat. And then we got to the last decade of expansion past the financial crisis, and we were able, as a society, as an economy, but the Fed had a role to play in this, one I'm proud of, really, is to continue to expand, to continue to grow above potential output growth, the level of D star, to push down unemployment, and to further improve labor force participation when literally every demographer in the country, the Bureau of Labor Statistics too, was saying labor force participation is on a downward trajectory because of the aging of the population. So I see these things as exactly the kind of thing that we now say have codified in the strategic framework document, which is that it's a broad and inclusive goal. So what do I mean by broad and inclusive? One of the things that we know happened in the 90s, happened in this past expansion prior to COVID, the gaps between, let's just say, Black and white workers, the gaps between Black and white workers, I've done a paper for Brookings on this with some colleagues, it starts to narrow. That's true whether you look at labor force participation, employment to population, unemployment, wages. These gaps start to narrow when the economy is strong. So how I interpret, my interpretation of the framework, why I was so supportive of the framework that we've released, is we are not going to, and I'm going to use parlance I know you all familiar with, we're not going to just take the punch bowl away from the economy when we have inflation running consistently below our target. We haven't been able to sustainably achieve 2% during the entire period. And just because we get to levels of unemployment that traditionally, historically, have meant that wage inflation was going to pick up and price inflation would be right behind it. We're going to learn about these things experientially. And that, to me, is the right risk management posture when we're so close to the zero lower bound. And we have a lot of room to keep inflation down to our target and much less room to get the economy up to its targets, especially the inflation one.
Right. So, but one of the things that I worry about is that suppose you reach I think Mickey alluded to this, suppose inflation does begin to rise. Hopefully it will in some sense, because
yes,
after all, we had 10 years of very low inflation that we struggled to get it up no matter what we did. Suppose inflation does begin to rise, how will the Fed think about the trade-offs of either using monetary policy to prevent or to stall inflation expectations from rising versus continue to put the pedal to the metal, so to speak, on the other side of the coin to achieve even more employment? And somebody, there's no question about it, the public and Congress will now claim you can't do this now because this unemployment rate or this labor market isn't working as well as we'd like it to do. How are you going to make those trade-offs and think about those debates that will come to the FOMC?
Well, I really don't in an era where we have a pretty flat Phillips curve, and I just for full disclosure, I still believe in the Phillips curve. I do believe that supply and demand work together, and the prices, the result of price and quantity and price is a good thing to look at. So if you're in the labor market, you should expect when the labor markets are really tight, the wage rate to go up. That's I still believe that's true, and so I still expect to see that happen. But what we've learned is there are many, many wedges that disrupt that simple model, and those wedges can make the Phillips curve flatter and muddy the relationship between a change in the unemployment rate and a change in the wage rate or the price level. So that's all true. But what I want to push away from is this idea that there's this stark trade-off. I want to be a student of history without being a victim of history. So a student of history looks at the 1970s, 1980s, 1990s, is my view, and says, look, we know that this relationship can be there. We need to study it. We need to look for a pickup in inflation that could be around the corner. But a victim of history expects that to happen no matter what, and I just don't expect that to happen. I think the world you just described, where we would get, in the one Mickey described, where we get a pickup in inflation that we don't first see in wage inflation, we don't first see in the unemployment rate and the other labor market indicators on the dashboard starting to really improve, look really good. And then we have this sustained pickup in inflation that's unrelated to any of those labor market variables. That seems to be a very low probability event when global inflation rates are falling, the pressure on inflation is downward. Most of the countries, especially European countries and Japan, they're struggling to use their policy tools to get their economy back up to its growth potential and to generate inflation. So I see this as the low probability event that if we are explaining to the public transparently all the different moves we're making, and I see Chair Paul doing this by having a press conference every time and all of us out there talking about this, that we will have people in a place where they'll understand, look, there's this sustained rise in inflation. Again, I think it's a low probability event that's unrelated to a strong recovery in the labor market, and we have to treat both of those. But then again, I will offer, I don't think of them in this trade-off space. I think of them in this balanced portfolio space. Ultimately, the goal of the Fed is to create healthy, sustainable growth for the economy so that people can do what they need to do, live their best lives or participate fully, right? So that is about price stability, full employment, and ensuring that the financial system remains safe and sound and able to intermediate.
So I think I still think that, look, we in the 40 years ago or whatever, in the 70s, we had very high inflation and very high unemployment, right? In the 2010, we had very low unemployment and very low inflation. So I guess my question is that I understand there's a sense in which you're still believing in the Phillips curve, which is fine. That's the operational tool the Fed has used for decades to conduct stabilization policy. But what would be then your answer to the question, what happened during the last decade when monetary policy was pretty accommodated through QE or through low interest rates, and we didn't generate any inflation? How do you think the Fed is going to get to its 2% target or higher in the short run? What is it going to do differently? Or what do you think is different about now where that's even possible?
Sure, that's a great question. So, I'll know you appreciate this. So a lot of what generates future inflation is inflation expectations.
Right.
And so I believe that. You can see this in any empirical analysis you do, that the role of expectations is a robust one. It's a growing one over the decades. What I was worried about in the waning parts of the expansion, which I didn't know were waning at that point in time, was that inflation expectations in the United States were drifting. I never believed that we lost the anchor of 2%, but I did see inflation expectations measured in a variety of ways looking like they're coming down. If you just look to our neighbors in Europe, they actually have the problem of it's tugging a lot at the anchor of inflation that they set out because their inflation expectations have come down as market participants, households, businesses realize that they just don't have that much policy space to fight off a downturn. So after delivering a strong and robust expansion and not hitting our target, my concern was that people would start to not believe we could hit 2%. So I'm very comforted, reassured, pleased, whatever word you would like to use, that when we released our framework statement in August, inflation expectations and the measures that I consulted, they came back up. And I believe that's because market participants in particular, but households and businesses, actually understand that the Fed doesn't think of 2% as a ceiling. The Federal Reserve is saying 2% is not a ceiling. We're going to achieve 2%. It's a symmetric goal, which we always said, but was hard to believe. And when we don't achieve it, and so we're going to have to overshoot 2% in order to get, for a sustained period, modestly, in order to get an average of 2%, given the downward pressure on inflation and the proximity to the ZLB. So why do I think, and this is to circle back to your question, why do I think we'll be successful? Well, one reason is because we've been very clear at communicating with agents, economic agents, that we are dedicated to average inflation of 2%. That is something that I think is important, and that we're going to overshoot 2 in order to get this average over time. The second thing is, I wanted to look back at the past decade. We did a lot of work on this. Mickey called for the Fed to do a lot of work. We were doing a lot of work, and lots of academics were working on this, and Fed Listens, we heard a lot of this. The labor market had more slack than anyone had penciled in the economics profession anyway. And we found that the labor market is far more elastic than we thought. I mean, I was a big proponent of it's pretty elastic. Andy's probably the biggest proponent of it's pretty elastic, but I was a big proponent of it's pretty elastic. And I was really encouraged and somewhat even surprised at just how many people were able to get jobs, come back into the labor force, and be productive in a time when we were able to sustain growth. So I completely want to echo what I heard in some of the earlier things. It's sustained economic growth that matters, and that's important, because having a person get a job for 1 month is not the same as having them get a job for a year or more than that. So it's unfortunate COVID took that away, but I think we have the recipe for doing it. Doesn't mean the future will be easy. I don't think it will, but we do have experience with doing the very thing that we wrote out in our strategy document.
Okay, well, let me jump in.
Thank you, Mary.
Thank you. I'm going to jump in because we have very little time remaining and the list of questions is burgeoning here. So I'm going to paraphrase some of them. So quite a lot is actually coming in on various aspects of conditions in the credit markets and what the response might be. So there was a question on the municipal market and state and local governments, and what was how you felt about that facility and whether it should be continued or whether support should be going more to state and local governments. And maybe a bit relatedly, as you alluded to, there has been a lot of refinancing activity, and that's been supported by basically federal forbearance policies, say through Fannie and Freddie and FHA and all of that. So as those policies come to an end, do you see that as a further impediment? So these are other frictions, state and local governments, the end of forbearance policies. Do you want to say a word about that?
Yeah, so let me just start by saying that, I would have, and I've been on record with this, I would have preferred that the full slate of facilities remain operational until we're fully through the pandemic. I just think of that as a necessary support for our economy, an important support for our economy. That said, I'll let Congress debate and with the new administration and the Treasury Secretary exactly which of those facilities we will work on in the future. But let me talk about this from just an economics perspective. So we have, and I think Athanasios talked about this in the beginning, or Peter, growth has been more positive than I think almost anyone forecast. The economy has been amazingly resilient in the face of COVID, supported by strong monetary and fiscal responses. So that's true. And we have a very deep hole to dig out of. once we get past COVID and we get the vaccine and we move forward. And that hole will not be made easier by all these other really collateral damage or knock-on effects from the original crisis. And state and local governments are an important one of those. State and local governments bear the brunt of the biggest burden of facilitating healthcare and other things, moving from in-person to online schooling, all the extra stuff. That's all just budgetary costs to these states and localities. And so they're going to need some kind of support, in my judgment, or else they will be a drag on growth. Right now, when I check in with my state and localities in my district, and you see this across the country, is they've been able to make it work. They were in a pretty good budgetary situation when they came into the crisis, and so they've been able to make it work. But as you know from previous, all of you know as economists, they tend to lag when they start to feel the real pain. And I think we're looking at 2021, especially the second half of it, when they're going to really start to feel some discomfort. And we're going to have to think about, as a society, if we let that be a drag on growth, then how much behind the eight ball do we put ourselves? The facility, the municipal facility, was only one aspect of that, but the take up there was low, in part because the municipalities were able to get funding in the private markets, and that facility was meant to facilitate the lack of, to repair any dislocation. So I'm more worried about aids to state and localities than I am about the facility per se.
Great. So also related to low interest rates, I guess, is growing concerns in some quarters that we're going to be moving into another asset price bubble, housing, the stock market, even the bond market. There's questions about sustainability. And I think there's a question essentially about your thoughts about how the Fed will respond this time around, how to kind of balance, I think, this need to continue stimulus to the extent you can and not have a reinflation of asset bubbles.
Well, absolutely. These are important topics. And, we have a full slate of statistics that we monitor, the quantitative surveillance. We publish the results of that twice a year. We are regularly looking at all of these things. These are important. The financial system is an important component of the health of the economy. But I will say, and I think this is important to say, is that those same concerns that you've just, itemized, they were concerns that we heard for the last several years of the last expansion. And importantly, when we took the rate cuts in 2019, we heard quite a bit of feedback that this was going to cause difficulties in the financial system. But in point of fact, banks came into the crisis well capitalized. We were on a strong footing. And so I want to make sure, and maybe this is, I know we're closing in on the end, this is a really important component. We need to think about financial stability. We need to think about all of these possible asset run-ups, but it can't be so scary that the possibility that can happen, that it hamstrings us from doing the important work that we've been given. Andy said, Congress is our boss. Congress gave us price stability and full employment. We have to work hard to achieve those goals, keeping financial stability in mind, but not letting it be sort of this proverbial boogeyman where we're so afraid of it because we just lived through it, that we become, again, a victim of history as opposed to a student of history. So as a student of history, I'm monitoring it constantly, but I do think that we have the situation right now in a good place, continuing to monitor it, continuing to think about it, while we do the work that's required to put the economy on a sound footing and be back on track for our dual mandate.
Great. Well, I know we're out of time, but I was also told that maybe if by your leave, I could ask one or two more questions and then we could wrap it up then.
Okay.
You have another minute or two. Okay. So there's several good questions, and I apologize to the people whose questions I can't get to. So actually a question came in regarding access, I guess, to Federal Reserve borrowing facilities, noting there's farm credit, but there's also community investment kinds of institutions that maybe would benefit from support from the Fed that might not have it, but in this kind of push to more inclusiveness and equity, whether there's some thoughts about broadening essentially discount lending or something for those kinds of institutions. So that's one question, and I have one more for you after that, and then I'll let you go.
Let me just do this one, quickly. It's a great question. I alluded to this earlier when Debbie, when you and I were having our conversation, that one of the things the pandemic has showed is that and we already knew it, but now it's really in stark relief, is that there are many, many institutions out there that could benefit from greater relationships so that we can get support out into the economy more quickly, because they serve different populations that are very important to the economy and to our mission, our mission as a Fed, but our mission as a country. So one of the things that's going to happen, like it happened after the financial crisis, we did a look back on all the tools, where were the pockets where we could make improvements, and then working hard to think about how you could make those improvements and how you do that in the regulatory environment we work in. So that's a top priority for me, and I know it is for many other Federal Reserve officials, is to investigate that and think about this so that we're prepared to assist more greatly at a great level in the next crisis, which hopefully won't be for a while.
Great. And as a last question, I promised Andy Levin that I would circle back to his issue. He would like me to ask you whether you think that the Fed is going to make progress in publishing information about its assessment of maximum employment along the lines of his paper, I suppose, and what he was talking about before, and, you know, whether you see that maybe there can be some progress towards more disclosure in that area.
So I appreciate, Andy, your thoughts, and I appreciate the call for more clarity. You know, I'm personally not ready, and I don't think it's a good idea. Debbie said, you know, do evidence-based policy making research, and I don't think we're ready to pick a single number. In fact, I think that could be dangerous. However well we compute the number, there's a danger in computing a number and then saying, well, that means we're there, when in fact it's a range of conditions, a whole portfolio, a dashboard. And I know this is unpopular because, you know, people say, well, that's squishy, a dashboard, I don't understand it. But let me just give an example. Say we pick this employment aggregate rate that you were talking about, Andy, but we don't see any wage growth. Well, then if I don't see wage growth, it's really hard for me to believe that the labor market's truly tight, no matter what we've achieved. You know, because it is a more durable and elastic entity than we've given it credit for in the past. And sometimes it's a less durable and elastic entity. And we're going to bump into wage inflation and price inflation one day that's stronger than our models predict. And I don't think we should take away the complexity and the real learning that can come from dealing with that complexity, because we want more clarity. I would rather be on the hook to the American people and to all of you on a more regular basis, holding myself accountable to the policies we make, than to give you a marker and say, okay, that's it, and when we've achieved it, we're there. So that's my view today, but I always remain humble and curious, so send me all your papers, all of you, and we continue to study these things. That's how we do our best work.
Great. Well, Mary, thank you so much. I know that was really a substantive conversation, and we all wish we could have dinner with you, as we would if we weren't in this time, and continue the conversation. So I'm going to turn it over now to my esteemed colleague, Greg Hess, who's going to wrap up with some final remarks.
Yeah. Well, on behalf of the Shadow Open Market Committee, I'd like to thank our hosts, Manhattan Institute. I'd like to thank our audience for their time and their questions, and I'd like to thank our panelists, especially President Mary Daly of the Federal Reserve Bank of San Francisco. The papers of the Shadow Market Committee members will be available on Manhattan Institute website, and the Shadow Market Committee's website is part of that one as well. It's been a wonderful conversation and discussion today. Great institutions like the Federal Reserve have great missions. The mission of the Federal Reserve has been given by Congress, which we sometimes just refer to as the dual mandate. It turns out, though, that great institutions also have great values that infuse that mission. In recent history, terms like transparency and credibility have been some of those values that have infused the Federal Reserve. Recently, the Federal Reserve, as we've talked a lot today, has included inclusivity as a new value. To summarize today, I think the challenge to the Fed is how to use those values that the Fed has adopted over the last 10 or 20 years of credibility and transparency, and how to adopt those values to better establish and articulate how its new value of inclusivity strengthens the Fed's ability to fulfill its mission and ultimately strengthens the Federal Reserve as an institution, one that betters all Americans. Thank you so much, everyone. We look forward to hosting you again at our next meeting.